Please like, share, and subscribe. Wishing you happiness and good luck every day.
All right, let's jump right in. Today, we are cracking open Short-Term Trading Strategies That Work by Larry Connors and Cesar Alvarez. And let me tell you, this isn't about chasing hot tips or relying on gut feelings. Nope, this is all about having a quantified statistical edge. An edge you get by doing the exact opposite of what the crowd is doing.
You know, it's funny. The entire philosophy of this book can actually be summed up by a quote from Seinfeld. I know, right? While Jerry's talking about fish here, he absolutely nails the core idea of being a contrarian trader. The crowd, well, they're the tuna, swimming with the current. But the real money, the real opportunity, that belongs to the salmon.
And there you have it. That's the whole game. To find a real, repeatable edge in the markets, you have to be willing to do what feels uncomfortable, what feels illogical. You have to be the one swimming against that current.
So let's get into our first section and see how this idea builds into a solid philosophy, because it all starts with completely rewiring how you look at the market. The authors make this crystal clear right from the get-go. See, in trading, mass psychology creates these predictable patterns. When a stock is shooting for the moon and everyone's excited, that little voice in your head, the logical one, says, buy, buy, buy. And when it's crashing and burning and fear is everywhere, that same voice screams, sell, get out. But the data in this book shows that this herd logic, it's usually a trap. And this quote right here, this isn't just some clever saying. It's a conclusion they reached after looking at decades of hard data. Every single strategy we're about to look at is built on this one foundation. Figuring out those moments when the crowd's obvious move is probably the exact wrong one. So, if we're not supposed to do what's obvious, what are we supposed to do? Well, that brings us to what is maybe the most important, actionable rule in this whole playbook, how you actually enter a trade. Let's look at two totally opposite approaches. Over here on the left, you've got breakout buying. This is chasing a stock after it's already had a huge run-up. You're basically buying into greed and excitement at a high price. But on the right, that's the book's core strategy, pullback buying. This is where you wait for a great stock to have a short-term dip, letting you buy into fear and uncertainty at a low price, right when the crowd is getting scared. So why on earth does this work so well? This quote just says it all. Markets are fueled by human emotion, and humans, well, we tend to overreact. A pullback is just a temporary overreaction of fear inside a bigger, longer-term uptrend. And by buying that fear, you put yourself in the perfect position for the likely snapback rally. Okay, so we get it. We need to buy pullbacks. But how do you identify that exact moment? How do you know when a pullback has gone too far and is ready to turn around? Well, that leads us to what the book calls a trader's secret weapon. Let me introduce you to the 2-period Relative Strength Index, or RSI. Now, most traders out there use a 14-period RSI, but the authors found that if you crank that down to a super sensitive 2-period setting, it becomes incredible at pinpointing these extreme short-term emotional shifts. When that 2-period RSI plummets, it's screaming that a stock is deeply oversold and probably ready for a big bounce. And the authors are serious about this. They literally call it as close to the Holy Grail as you can get. All right, theory is great, but let's put it into practice. Let's walk through a really powerful market timing strategy straight from the book that ties all of these ideas together. Okay, let's break this down because each rule is designed to stack the odds in our favor. First, we only trade when the overall market is healthy. That's what the SPY being above its 200-day moving average tells us. Next, we wait for a massive spike in fear and we measure that using the VIX. Then, for our fourth step, we pull out our secret weapon, the 2-period RSI, to confirm the market is way oversold. It's only when all of these planets align that we actually buy. And the exit? Just as disciplined. We sell when the RSI tells us the strength is back. But the big question, does it actually work? Well, according to the book's testing over 92 different trades, this exact strategy was a winner 79.35% of the time. Now, that is the power of a quantified contrarian approach. It's not about being right every single time. It's about having a huge statistical edge that plays out over and over again. You know, getting into a trade is really only half the battle. Now we've got to talk about the parts that are equally critical and honestly, often a lot harder. How to get out and how to manage the person staring back at you from the screen. Now, this next idea is going to sound like heresy to a lot of traders. The conventional wisdom is you always use a hard stop loss. But the authors tested hundreds of variations and found something shocking.
For these specific pullback strategies, traditional stop losses actually hurt your results. And think about why. You're buying at the point of maximum pessimism. A tight stop often gets hit by that one last gasp of selling, shaking you out at the worst possible moment, right before the price rockets higher.
This brings up a really critical question, doesn't it? If you're not going to use a mechanical stop, then that discipline has to come from somewhere. It has to come from you. And this is where trading stops being a technical game and starts being a psychological one.
The book uses this incredible analogy from a former Navy SEAL. When you're in a high-stakes, high-pressure situation, you can't be thinking about what went wrong on the last mission or what might happen on the next one. You can't worry about the outcome. Your entire total focus has to be on one thing: executing the step right in front of you perfectly. It's all about the process, not the outcome.
And that is the ultimate lesson here. The charts, the indicators, the rules, they're just tools in your toolbox. Your real edge, your secret weapon, is a prepared, disciplined mind that can execute the plan without letting emotion get in the way, trade after trade after trade. Wow, we have covered a ton of ground. So for our final section, let's boil all these core ideas down into one simple, actionable playbook that you can take with you.
So here's the cheat sheet. You buy weakness, not strength. You only trade in the same direction as the long-term trend. You use fear measured by the VIX as your go signal. You need to rethink your use of hard stops. You trust the data that says it pays to hold positions overnight during a panic. You make that 2-period RSI your best friend for finding entries. You always have a plan to sell into returning strength. And most important of all, you remember that none of this works without a disciplined mind.
So there you have it, the quantified playbook of a contrarian trader. The strategies are laid out, the stats are there to back it up. But the final, most crucial piece of this puzzle isn't on any chart. It's your commitment to actually execute the plan. So the only question left is, are you ready to be the salmon?
Welcome to The Explainer. Today, we're going deep. We're going to crack open the black box of what it really takes to be a professional trader. And look, we're not just talking about charts and tickers here. We're decoding a mindset, a strategy that isn't just about making a quick buck, but about surviving and actually thriving when the market inevitably turns against you. It's a whole philosophy built on cold, hard evidence, not the hype you hear on Wall Street.
You know, this quote from Samuel Johnson, it just hits different. It perfectly captures that feeling, right? It's not just about taking a risk, it's about that terrifying, crystal clear moment when you've pushed all your chips to the center of the table. There is no going back. And that's exactly where our story kicks off. Okay, picture this. It's March 4th, 1994. You've just walked away from a very stable, very comfortable 6-figure career. There's no more salary coming in, no more safety net. From this day forward, it's simple. If you don't perform, you don't eat. Oh, and you've got a family at home that's counting on you. This was the reality for the author of our source material, a massive, high-stakes gamble that would force him to unlearn pretty much everything he thought he knew about the markets.
Now, to be fair, he wasn't starting from absolute zero. Thanks to that roaring bull market in the 80s, he had the capital. But as he was about to find out, having the money to play the game is one thing, surviving it is something else entirely. The real problem he was facing wasn't financial at all. It was something way more fundamental.
So, what was it? You know, if money wasn't the issue, what was this invisible wall standing between him and actually making a career out of this? Well, the answer is a pretty stark reminder of just how much the world has changed, because it had absolutely nothing to do with the markets themselves. It was a total information vacuum. I mean, just think about that for a second. Today, you and I are literally drowning in YouTube tutorials, books, courses, you name it. Back then, the pros guarded their secrets like they were the crown jewels. It was a closed club, and if you weren't on the inside, you were basically flying blind in a hurricane. And that information desert of the past, it's almost unrecognizable today. The entire world of trading has been completely transformed, for better, and you could argue for worse. It's created a whole new set of challenges that are just as tough to overcome. So, we've swung from one extreme right to the other. We went from a world of total secrecy to a world of just deafening noise. The problem isn't the lack of information anymore. It's an overwhelming, crushing abundance of it. The real challenge now is trying to find the signal in all that static, to figure out which of the 100 opinions you hear every day might actually be right, and which are just, well, noise.
And the tools? Oh man, the tools have changed everything. The author talks about spending days, sometimes even weeks, just hunched over notebooks, manually backtesting a single idea. One idea. Today, with modern software, you can do that same process, testing, validating, and optimizing an entire strategy in literally the time it takes you to go make a cup of coffee. It's a night and day difference. But here's the paradox in all that progress. All that new technology, all that instant information, it's made the market brutally efficient. The simple, easy-to-spot opportunities, those little glitches in the matrix that traders in the 90s could exploit for a living, they've been almost entirely competed away. They're gone. And these weren't just theories. These were real, concrete, money-making strategies. You could literally make a reliable living just by getting key news a couple of minutes before the rest of the market. The author calls them the 1990s version of an ATM. You just had to know the code. Well, today, those ATMs are permanently out of service. Which, of course, brings us to the million-dollar question. If the easy money is gone and the old playbook is basically useless, how does anyone build a sustainable career in trading today? Is there some underlying principle that doesn't change no matter how fast or efficient the market gets? Is there a timeless edge?
Well, it turns out there is. And the key wasn't found by inventing something new and complex, but by observing what the legends of the industry, we're talking traders who have navigated decades of market chaos, not just one good bull run, what they all had in common.
And it all boils down to this one powerful kind of counterintuitive concept, reversion to the mean. It's the simple but profound idea that things stretched too far in one direction have a powerful tendency to snap back, kind of like a rubber band. When prices get way overextended, usually because of fear or greed, they're very likely to reverse and return to their historical average.
And this quote, it just nails the philosophy in action. It's fundamentally about being a contrarian. While the amateur crowd is panic selling at the bottom, the pro is actually looking for an entry point. And while that same crowd is euphorically buying at the top, the pro is looking for a place to sell. They're trading from a position of strength by fading the emotional extremes of the market. But look, a philosophy isn't a strategy. It's one thing to have a cool theory. It's a completely different thing to prove it works with real money on the line. And this is where the idea of trading by the numbers comes in. And a really powerful analogy from professional sports makes this crystal clear. This is such a great question. It gets right to the heart of it. In baseball, the whole Moneyball revolution proved that a data-driven approach could consistently beat teams with massive payrolls. General managers use cold, hard statistics to build championship teams. So why, when we're talking trillions of dollars at stake, does so much of Wall Street still operate on gut feelings, hot tips, and the opinions of talking heads on TV? And this slide just lays it out perfectly. You've got two competing philosophies. The old way is subjective. It's based on a story, a gut feeling, a guess. The new quantitative way is objective. It's evidence-based. It doesn't ask, what do I think will happen? It asks a much more powerful question. What has happened historically, the last 100 times we've seen this exact setup? It replaces guesswork with probability. And this isn't just a fun theory. It's a proven championship formula. After the book Moneyball came out, teams that really embraced statistical analysis like the Red Sox and the Cardinals, they went on to break curses and win multiple World Series. They proved that in a hyper-competitive game, a statistical edge isn't just an advantage, it's the winning edge. Okay, so if we accept this Moneyball idea for the markets, that a quantifiable edge based on reversion to the mean is the key to long-term success, what are the actual building blocks? How do you go from this cool theory to a practical, systematic approach you can actually use? Well, it becomes a systematic four-part process. First, you hunt for the pullbacks. You are actively looking for those moments of weakness, those overextensions in the market to buy into. Second, you define your entries with absolute precision. You use a quantified signal, something like the 2-period RSI, which is just a simple tool to measure short-term momentum, to tell you exactly when that rubber band is stretched too far. Third, and this is so important, you master your exits. You need a predefined strategy to capture that statistical edge. And finally, the hardest part of all, you have to conquer your own psychology to actually follow the plan, especially when every fiber of your being is screaming at you to do the exact opposite. And that really brings us to the final critical question you have to ask yourself, whether you're a day trader or a long-term investor. When you make a decision in the market, what's really driving it? Is it a story you heard on the news, a gut feeling, an opinion from some so-called expert? Or is it backed by hard data and statistical evidence? Because that is the difference between gambling on hunches and trading with a timeless, quantifiable edge. You know, sometimes the most profound lessons come from the most unlikely places. We're going to kick things off with a classic TV moment that, believe it or not, holds a fascinating key to understanding the market. It's a powerful idea wrapped up in one of the greatest epiphanies in sitcom history.
And there he is, the one and only George Costanza from Seinfeld. He's hit absolute rock bottom. And in that moment, he has this flash of incredible clarity. He realizes that every single instinct, every gut feeling he's ever followed has been completely, spectacularly wrong.
So what does he do? This is the brilliant part. He doesn't just try to make a better choice, he decides to do the exact opposite of what his instincts tell him. His go-to lunch is tuna on toast, so he orders chicken salad on rye, untoasted. It's his first step into a brand new, counterintuitive world. And Jerry, of course, just nails the logic behind it. It's so simple, but so powerful. If your internal compass is fundamentally broken and always points south, well then, the only way to go is north. It has to be right. Okay, this is where we pivot, because this is the big question. What if we took George's opposite theory and applied it to trading? What if all the conventional wisdom, the stuff that feels right and everyone tells you to do, what if that's the market's version of tuna on toast? We're going to dig into this, not as financial advice, but as a really fascinating look at contrarian thinking, and it's backed by some pretty shocking data. So let's start with that conventional wisdom. You know the drill. Turn on any financial news channel and you'll hear it. The market's hitting new highs. The advice is always the same. Jump in, buy the breakout. It feels safe, right? Buy when things are going great. But here's the thing. Does that strategy actually work? Does following the herd when everyone's excited really pay off? The source material for this explainer put that exact idea to the test. So let's put your instincts on the line with a quick quiz based on a huge bull market. Okay, question 1. The market is on an absolute tear for 13 years. It more than triples. So let's say you follow the advice to the letter. Every single time the S&P 500 hits a new 10-day high, you buy. You're buying into strength, just like you're supposed to. How do you think that turned out? All right, now for question 2. Here, you're doing the opposite. At that same 10-day high, when everyone else is feeling euphoric and buying, you decide to bet against the market. You sell short. How did that move work out during one of the biggest bull runs ever?
And for our last question, we go full Costanza. You completely flip the script. You don't buy strength, you buy weakness. Every time the market pulls back and hits a new 10-day low, when everyone's scared and the headlines are negative, that's when you decide to buy. So what was the result of that strategy?
Okay, got your answers ready? Let's pull back the curtain. Now remember, this is a look back at historical data from a specific time, but the results, wow, they really challenge some of the most basic assumptions people have about trading. So let's start with the one that feels like a sure thing, buying the breakouts. The expectation is obvious, right? In a roaring bull market, this has to be a winning strategy. But the reality, well, it's something else entirely. Yeah. That's a minus sign. In a period where the S&P 500 gained over 1,000 points, a strategy of consistently buying the highs would have actually lost you almost 100 S&P points. Just let that sink in. The most popular advice would have cost you money in a massive bull market. And this number right here tells you exactly why. The win rate was just 41%. That means that more than half the time, buying that exciting new high was the wrong move in the short term. The odds were literally stacked against you. Now look at this when we put it all together. It's just incredible. Buying the highs, a loser. But doing the opposite, shorting those same highs, was actually profitable, with a nearly 60% win rate. But the real showstopper, the Costanza strategy, buying the 10-day lows, that one captured almost the entire gain of the market, over 1,000 points with a stunning 73.5% win rate. The difference is just night and day. So, the big question is, what's going on here? Why would the most intuitive strategy fail so miserably, while the counterintuitive ones worked so well? Well, the theory behind it all comes down to one thing. It's all about human psychology. Think about it. By the time a market hits a new high, the news is amazing. Everyone is optimistic. Everything feels great. But the problem is, all that good news is already reflected in the price. It's been priced in, leaving very little room for prices to go much higher, at least in the short term. And, you guessed it, the exact same thing happens in reverse at the lows. When the market hits a bottom, the news is terrible. Everyone is panicking, and fear is everywhere. But all of that bad news, all of that pessimism, is probably already baked into the price.
This suggests that the moment of maximum fear is often the moment of maximum opportunity.
All right, so how do we take this and turn it into an actual framework for thinking? Because this is more than just a cool piece of trivia. The analysis uses this data to suggest a totally different way of looking at the market. So what are the actual takeaways here?
The source material really boils this all down into 4 simple but powerful rules for how to approach things. Now, these aren't some kind of magic formula, but they are the logical conclusions from the data we just walked through. So the first rule is pretty clear. Be really skeptical about buying those breakouts. The numbers just aren't on your side. Second, a new high might actually be a better signal to take some profits off the table rather than pile in more. And third, this is the core of the whole opposite idea. The data strongly suggests that buying pullbacks, buying on the dips, is a much better strategy. And all of this leads to the final point. You have to learn to ignore the emotional noise, both the wild excitement and the terrified panic, because the price is likely already factored all in.
This quote from the analysis just says it all, doesn't it? It's true in markets, it's true in life. By the time an idea becomes the consensus view, by the time everyone agrees on it, it's often too late. The real opportunity is usually where nobody else is looking.
And that really brings us to the final and most important idea here. This whole explainer isn't about giving you a secret trading system. It's about a mindset. It's about challenging your own instincts. So the next time you feel that powerful urge to jump in with the crowd, whether it's out of excitement or fear, just pause for a second. Remember George Costanza and his chicken salad on rye. Question the consensus and dare to think differently. That might just be the most valuable move you can make.
You know that feeling, right? That pit in your stomach when the market takes a dive and every single news channel is screaming sell? Or that incredible urge to jump on the bandwagon when everyone's popping champagne over a new high? Well, today we're diving into a trading rule that says you should probably do the exact opposite. It's all about tuning out the noise, and as you're about to see, the data backs this up in a way that's pretty incredible.
All right, so here's the game plan. First, we're going to pick apart that media hype trap that so many of us fall into. Then we'll get into the actual logic of why following the crowd can be a losing game. From there, we'll build out a totally counterintuitive strategy, and this is my favorite part, we're going to put it to the test with 13 years of real S&P 500 data. And finally, we'll wrap it all up with one simple new trading rule that you can start thinking about.
Okay, let's start with a scene we all know way too well. You flick on the TV, and what do you see? It's pure financial theater, isn't it? A total roller coaster of emotion, with so-called experts breathlessly telling you whether you should be feeling greedy or terrified about your money. Right this second.
I mean, this quote from our source material just hits the nail on the head. Think about it. When the market is flying high, it's all bull graphics and victory laps. But when it's tanking, oh, it's all red arrows and furrowed brows. It's a whole spectacle designed to get you hooked on the emotion of the moment.
And this right here breaks down the 2 predictable scripts they always follow. On the left, after a rise, it's a party. Everyone's a genius and we're all going to the moon. But look at the right. After a drop, the mood just flips completely. The same experts are now telling you exactly why the sky is falling. It's this exhausting, endless cycle of euphoria and then panic.
So we're getting this emotional whiplash from the experts, but here's the kicker. A lot of the time, they're dead wrong. So the real question is, why? Why does jumping in with the crowd so often lead you astray? And that question gets us right to the heart of our strategy.
And that right there is the million-dollar question. I mean, these are supposed to be the pros, so why are their gut reactions so often a trap for the rest of us? Well, the answer isn't about how smart they are, it's about a fundamental idea of how markets actually function.
The key concept here is something called market efficiency. Just think of the market as this giant, super fast prediction machine. By the time you hear about a company's amazing earnings report on the news, thousands of investors already saw it coming. They bought the stock, and that good news is already priced in. And it's the same for bad news. The market reacts to whispers long before they become headlines.
So when you see an analyst on TV explaining why the market just went up or down, they're not a fortune teller. They're more like a historian. They're just describing something that already happened, and the price is already adjusted. They're not giving you a crystal ball for the future. They're showing you the rearview mirror.
And look, it's so important to get this. This isn't some new trend. This is basically the physics of how markets have worked for decades, how they work today, and let's be honest, how they're almost certainly going to work for decades to come. It's a fundamental truth. Okay, so if we know the news is just yesterday's story and that chasing all that emotional hype is a trap, What's the alternative? And that question leads us to a strategy that, I gotta admit, feels totally wrong at first, but it's built on some seriously solid logic.
Exactly. It's one thing to understand a concept, but it's a whole other thing to actually use it to make better decisions. So how do we take this knowledge about market efficiency and media hype and turn it into an advantage?
The answer, in short, is to become a contrarian. You actively, intentionally go against the herd. You have to train yourself to see widespread panic not as a reason to run for the hills, but maybe as a potential for sale sign. And you see all that market euphoria not as a party you need to crash, but maybe as a warning that the room is getting a little too crowded.
And that boils down to two really simple but powerful rules. First, when the news is all sunshine and rainbows and you feel that intense FOMO after a few great days, you hold back. The party might already be winding down. Second, when the headlines are terrifying after a few bad days and you feel that panic rising in your chest, you resist that urge to sell too. The fear has probably already done its damage.
Okay, so this all sounds pretty good in theory. Be brave when others are fearful, be cautious when others are greedy. But does it actually work in the real world? Is there any proof? Well, let's stop talking theory and look at the hard numbers from the S&P 500.
So our source material points to a study that dug into 13 years of market behavior. This isn't just an idea anymore. It's a testable hypothesis. Let's see what the data actually showed.
So the study set up this really clear head-to-head comparison. It looked at every single time the S&P 500 fell for 3 days straight, and then it measured what happened over the next 5 days. And then it did the exact same thing for every time the market rose for 3 days straight. So what happened next?
The results are, honestly, they're staggering. When the market had dropped for 3 days in a row, the exact moment when the news is full of doom and your gut is screaming, get out, the market's return over the next week was more than 4 times its average. Think about that. The panic was a false alarm. It was actually a buying opportunity.
But, and this is just as important, here's the other side of that coin. After the market rose for 3 straight days, when everyone was feeling great and celebrating, the S&P 500, on average, actually lost money over the next week. The celebration was a warning sign that things were about to cool off.
And this chart just lays it all out crystal clear. Look at that bar on the left. That's what you got for buying after a 3-day rise, an average loss. Now look at the bar on the right. That's the result of buying after a 3-day drop, a huge positive return. The data just couldn't be any clearer. It's a night and day difference. So let's recap. We've seen the media trap, we get the logic behind market efficiency, and we've looked at some pretty undeniable data. The only thing left to do is to put it all together into one simple actionable rule.
And really, it's that simple. This one sentence is the main takeaway from all of this. It's a guiding principle that can help you filter out all that emotional noise and just focus on what the data suggests is a higher probability move. Fight the feeling and follow the logic.
So here it is, your new contrarian rulebook. When the market's been down for a few days and fear is hanging heavy in the air, that's not your cue to panic. It's your cue to start paying attention. And on the flip side, when the market's been rallying for days and everyone's breaking out the confetti, that's your signal to be patient and resist the urge to chase.
And so we'll end with this thought. In a world that is just screaming at you 24/7 with nonstop news and emotional hype, what if the most profitable, the most powerful move you can make is to just turn down the volume and have the courage to quietly walk in the other direction?
All right, let's break down a trading rule that's, well, it's remarkably simple, but it is incredibly powerful. It's not really about finding the next big thing, but more about something way more important, helping you sidestep some of the biggest, ugliest disasters in the market. So let's dive into trading rule number 3, the 200-day moving average. Okay, so here's a situation I'm sure you've been in. You see a stock you really like, maybe one you've had your eye on for ages, and suddenly its price is just tanking. And that little voice in your head starts whispering, hey, it's on sale. This is my chance to buy low. But then there's that other voice, right? The cautious one that asks, is this a real bargain? Or am I about to walk right into a trap? You know, this temptation actually has a name. It's called bottom fishing. It's that hunt for the absolute lowest point of a stock right before it's supposed to shoot back up. And look, the appeal is massive, right? If you time it perfectly, the profits can be huge. It feels like you've completely outsmarted the market. But, and this is the million-dollar question, isn't it? What if there is no bottom? What if that sale price just gets cheaper and then even cheaper, wiping out your entire investment along the way? That is the critical risk that turns a potential bargain into an absolute nightmare. So let's dig into the psychology here for a second. What is it about buying low that's so tempting? It feels so intuitive, but as we're about to see, it's often a siren song that leads investors straight toward the rocks.
And this quote it nails it. This is such an insightful warning sign. Think about it. When a high-flying growth stock, one that everyone loved for its future potential, suddenly starts being talked about as a value play, that's a huge red flag. The whole story has shifted from excitement about the future to just hoping the price is low enough to be worth the risk. It's a subtle change, but it's a critical one.
So, if trying to buy the dip is so risky, how do we protect ourselves? Well, according to this strategy, the answer is a really simple technical indicator. Let's meet the hero of our story, the 200-day moving average. So, what is this thing exactly? Honestly, it's not complicated at all. You literally just take the closing price of a stock for the last 200 trading days, you add them all up, and then you divide by 200. What you get is this one smooth line on a chart that kind of filters out all the crazy day-to-day noise and gives you a really clear picture of the stock's long-term health. And this is the best way to think about it. The 200-day moving average is just a line in the sand. It's a simple, objective, dividing line. If the stock's current price is above that line, the long-term trend is generally healthy. It's in an uptrend. But if it falls below it, that's a crystal clear signal that the trend has turned sour. It's such a simple but powerful distinction. Okay, now, all of that sounds great in theory, but does it actually work in the real world? This is the point where we get to move past just opinions and gut feelings and look at some hard evidence. We're going to see what a massive research study found when it put this very simple rule to the test. 8 million. That is the number of trades they analyzed in this study. So we're not talking about a small sample size or some niche observation. No, this was a deep, comprehensive dive into market behavior over a really long time. The scale here is what gives the results so much weight. And the question these researchers asked was incredibly simple. They just wanted to know, how do stocks perform in the 5 days after a trade? And they compared two scenarios, when the stock is trading above its 200-day moving average versus when it's trading below it. It's basically a gigantic A/B test. And the results were pretty darn clear. On average, stocks that were above their 200-day line gained about 0.25% over the next 5 days. But stocks below the line, they only gained 0.18%. Now, that difference might not sound huge, but when you compound that over millions and millions of trades, it reveals a persistent statistical edge. It shows you that the wind is just much more likely to be at your back when you're on the right side of the trend. So the bottom line is this. The data actually backs up the theory. Of course, anything can happen on any given day, but the odds are simply better when you're buying stocks that are already in a confirmed uptrend. And in investing, finding those little edges, well, that's the whole game, isn't it? But the real power of this rule isn't just about finding that small performance edge. It's about avoiding total and complete disaster. So now, let's step into what I'm calling a gallery of collapses. Some famous, cautionary tales that show the devastating consequences of being on the wrong side of that line in the sand. And you have to get this next part because it's so important. From Enron to the dot-com bust to the 2008 financial crisis, the story is almost always the same. The truly catastrophic wealth-destroying collapses, they almost always happen after a stock has decisively broken below its 200-day moving average. That's the danger zone. Just look at Bear Stearns here. You see that smooth, curving line? That's the 200-day average. Notice how the stock price crosses below it and then just falls off a cliff. For months, it was trading below that line, sending up a massive warning flare long before that final dramatic collapse. It's the exact same pattern with Washington Mutual. Once it fell below the 200-day line, it never came back. Every little pop was just another chance to get out before the next leg down. The vast, vast majority of those awful losses could have been avoided by just respecting that line. And here we go again with United Airlines. For a while there, things were great for investors, but once the stock broke that long-term trend, the turbulence got extreme. The plunge afterwards was fast and it was brutal, and it all happened in that danger zone below the moving average. Oh, and Citigroup. This one is the perfect example of that value trap we talked about. As it was sliding lower and lower, well below the 200-day line, how many times did you hear somebody on TV say it was cheap, that it was a bargain? Every single one of those calls was another trap for investors who were just ignoring the clear message from the trend.
And finally, Countrywide Financial. This chart just says it all. You know, as the source material points out, all of these stocks looked cheap on the way down, but they just kept getting cheaper and cheaper and cheaper until there was almost nothing left. This is the ultimate danger of bottom fishing in a broken stock.
Okay, so after looking at that graveyard of stocks, let's pull back and focus on the core lesson. This isn't about some complicated get-rich-quick scheme. It's about a simple rule for safety and, just as important, for your own sanity as an investor.
Now, we've got to be really clear about what this rule is and what it isn't. It is not foolproof. It is not a guarantee that you're going to get rich. Think of it more like a powerful filter. Its number one job isn't to make you a millionaire. It's to keep you out of the kinds of stocks we just looked at, the ones that cause catastrophic, life-altering losses. It's all about putting the odds in your favor by swimming with the current, not fighting against it.
And this last thought really brings it all home. I mean, investing is hard enough as it is, right? Why try to be a hero and catch a falling knife? Why not just focus your money and your mental energy on stocks that are already showing strength and positive momentum? Not only is it statistically more likely to work out, but man, it is so much less stressful.
So I'll just leave you with this one simple, powerful question. The next time you feel that urge to go bottom fishing, the next time you hear that some stock is on sale, just take a second, pull up a chart, find that one simple line. Before you click buy, are you checking the long-term trend? It might just be the most important question you ever ask.
All right, welcome back. Today, we're going to dig into a really powerful market timing rule. It's all about turning the market's biggest emotional swings, fear and greed, into your biggest advantage. We're going to learn how to actually quantify those emotions and use that to make much smarter decisions.
So let's just jump right in with a question for you. Have you ever felt that knot in your stomach when the market's plunging and you just want to sell everything? Or how about the other side? That serious FOMO, that fear of missing out, when a rally is red hot and you just feel like you have to get in? Well, those powerful emotions, fear and greed, they often push us to do the exact opposite of what we should be doing.
The biggest problem for so many traders is that they let emotion get in the driver's seat. And that almost always leads to the number one sin of investing, buying high and selling low. But what if we could completely flip that script? The source material is super clear on this. Fear is that voice just screaming at you to panic sell right at the bottom, literally moments before a potential recovery. And greed? Well, that's that little whisper of euphoria, right? Convincing you to pile in at the very peak of a market cycle just before things might turn south. Now, what if I told you there was a tool that could actually measure this collective emotion in the market? A kind of fear gauge that tells us when panic, or on the flip side, complacency, is reaching an extreme. Well, that tool is the VIX. The official name, it's a mouthful, the Chicago Board Options Exchange SPX Volatility Index. But don't worry about that. All you really need to know is this. It's the market's best guess on how much the S&P 500 is going to swing up or down over the next 30 days. So just think of it as the closest thing we've got to a real-time fear-o-meter for the stock market. And this is where it gets really interesting. The VIX has this inverse relationship with the market. It's kind of like a seesaw. When the S&P 500 goes down, fear spikes and boom, the VIX goes up. This often means pessimism has gone way too far, and that could be a buying opportunity. On the other hand, when the market rises, investors get comfortable, fear disappears, and the VIX falls. This can be a huge warning sign to maybe think about taking some profits off the table. Okay, but here's the thing. The VIX is an incredibly powerful tool, for sure, but most people, they use it completely wrong, and that just robs them of any real edge they could have. So listen up, because this is the absolute key. Just looking at the VIX level in isolation, seeing a VIX at, say, 20 or 30 is a massive mistake. It tells you almost nothing on its own. The source is very emphatic here. Using a single static number to make a decision is just the wrong way to do it. So, the right way to use the VIX is to look at it in context, and luckily, it's a really simple two-step process. First up, you just find the VIX's current closing level. Easy enough. Second, and this is the most important part, you compare that number to its 10-day simple moving average. Now, a moving average just smooths out the data, right? It gives you the average value over the last 10 days, and that tells you its recent trend. See, that's the whole idea right there in a nutshell. It's not about whether the VIX is high or low in some absolute sense. It's all about how stretched it is relative to its own recent behavior. So a VIX that has spiked way above its 10-day average suggests fear is running high and the market might be oversold. And a VIX that's dropped below its average, that suggests complacency is creeping in and the market could be overbought. Okay, so how do we actually use this? How do we turn this insight into a concrete, actionable strategy? Well, that brings us to what the source material calls the VIX 5% rule, and it's a specific data-backed approach. Now, the author makes a really bold claim here, and it's definitely worth paying attention to. They say that if you could only use one, just one, sentiment indicator to guide your trading, this should be it. That's a pretty powerful endorsement, right? All right, here it is, the whole rule laid out on one slide. And you can see it split into two really clear signals. The buy signal that happens when the VIX closes 5% or more above its 10-day moving average. The sell, or let's say caution signal, that triggers when the VIX closes 5% or more below its 10-day average. And just look at those historical outcomes going back to 1995. They are completely different. Let's just stop and really look at that number on the buy side for a second, because the numbers are pretty staggering. We're talking about a 2-to-1 advantage. What does that actually even mean? It means that in the weeks that followed a signal where fear was really high, when that VIX was 5% or more above its recent average, the S&P 500's returns have historically been more than double the average return for any random week. That is a massive statistical edge. But now, let's flip it around and look at the other side of the coin. That caution signal, the one that triggers when everyone's feeling complacent. The historical result here is just as dramatic, but for the exact opposite reason. A net loss. And this is what's absolutely fascinating to me. Just think about it. The S&P 500 has trended up for decades, right? But the 5 trading days after the VIX closed 5% or more below its 10-day average have, on average, actually resulted in a loss. That is a powerful piece of data. It tells you these moments of extreme greed and complacency are historically terrible entry points, even in a strong rising market. So let's bring it all together. What does all this actually mean for you? How can you apply this to get a real, tangible trading edge? At the end of the day, it really just boils down to this simple strategy. The data strongly suggests your edge is in buying the market when the VIX is stretched to the upside, at least 5% above that 10-day moving average. That's what it means to buy fear. And on the flip side, it's time to be cautious, maybe lock in some gains, and definitely avoid new purchases when the VIX is 5% or more below its average. And that is selling greed. You know, the rule itself is pretty simple, right? But as we've seen, actually executing it, well, that takes discipline. It requires you to go against your deepest instincts, to act against that herd mentality. The data gives you a clear, logical framework to follow. So the final question is, are you going to use it to your advantage? In the world of trading, you hear a lot of rules, right? Things are told are fundamental, that you should never, ever break. And probably the biggest one of all is always use a stop loss. But what if I told you that one of the most widely accepted pieces of trading advice was actually hurting your performance? So the person whose work we're digging into today was a huge believer in this rule. I mean, if you looked at anything they published before 2004, you'd see it again and again. Use stops, protect your capital. It was just standard, unquestioned wisdom. And that's where things get really interesting. Because what happens when you stop just accepting a rule and decide to actually test it? When this author and their team set out to find the perfect stop-loss level, they stumbled onto something that turned everything they believed completely on its head. Okay, so here's our game plan. We're going to start with that golden rule everyone's taught. Then we'll get into the surprising discovery they made and look at the hard data behind it. After that, we'll break down why stops might be hurting you, and super importantly, we'll finish with the necessary fine prints you absolutely have to know. All right, let's kick things off with the advice that, let's be honest, we've all heard from day one. It sounds so logical, so responsible, it feels like you can't even argue with it. The logic is pretty simple, right? Trading is risky, so you need some way to cut your losses before they totally blow up your account. The stop loss is sold as this perfect automatic safety net. It's supposed to take all the emotion out of the decision. And you hear this everywhere, in books, on forums, and courses. It's basically trading gospel. So how does something like trading gospel begin to fall apart? Well, back in 2005, the team's goal wasn't to challenge this golden rule at all. It was to make it better. They just wanted to find the perfect stop-loss percentage. You know, that sweet spot. And we're not talking about a quick weekend project here. They ran hundreds of tests, tweaking stop levels across a massive number of trades. They were all in on finding a data-backed answer. So they started from this place of total belief in stops, but the data started telling a completely different story. And it's really important to give credit where it's due. This wasn't some solo mission. This was a serious research project, and the author's director of research, Cesar Alvarez, along with David Wowminster, were the ones who really drove this discovery. They were the ones who first spotted this crazy pattern in the numbers. This quote just says it all, doesn't it? It really captures that feeling of total shock. Imagine you go in looking for the best stop to use, and the data comes back practically yelling at you that the answer is none of them. Every single test just kept pointing to the same unbelievable conclusion. So what did the numbers actually say? Let's get our hands dirty and look at one of the specific tests, because it's a perfect example of what they were seeing across the board. Okay, so here's the setup for the test. The strategy is to buy a fundamentally strong stock, so one that's trading above its 200-day moving average, but you're buying it on a dip, specifically when it closes at a 10-day low. The exit plan is to sell either when it shows strength again by closing above its 10-day moving average, or if the trade goes against you when your stop loss gets hit. Simple enough? Now to test this, they used a massive data set. We're talking over 230,000 trades. They ran the numbers for all sorts of stop loss levels, from a super tight 1% all the way out to 25%. And they compared all of that against one baseline. What happens if you just don't use a stop at all? They were hunting for that sweet spot, but the data had other plans. And this chart just lays it all out there. It's a brilliant picture of what that mountain of data showed them. You can see right away, the performance with those really tight stops, yeah, not great. It gets a little better as the stop gets wider, but then just look at that bar all the way on the left, the one labeled none. The strategy with absolutely no stop loss was the hands-down winner. It beat every single other variation. And it all boils down to this one number, a 0.58% average profit per trade when no stop was used. Every other scenario, every single one with a stop loss attached, came in lower. The data couldn't have been clearer. The best way to trade this strategy was to break the golden rule. So after running hundreds of these tests, the conclusion was just inescapable. For this kind of stock trading, any stop loss, no matter where you put it, was a drag on performance. And here's the real kicker. The tighter you made that stop, the more money it cost you. Even a crazy wide 50% stop still performed worse than no stop at all. This is just so backwards from what we're taught. It really makes you ask, why? Why would a tool that's designed to protect you actually end up hurting you? Well, the answer seems to be in the unique way the stock market behaves. There are really two big things going on here. First, the pros and the market makers, they have a pretty good idea where all the amateur traders are putting their stop-loss orders. And sometimes they can push a price down just enough to trigger that wave of selling. It's called gunning for stops before they let the price bounce right back. And second, maybe more importantly, stocks just tend to revert to the mean. They often overreact to bad news, drop too far, and then bounce back. And I bet this quote right here feels painfully familiar to a lot of traders out there. You see a stock dip, your stop loss kicks you out of the trade to protect you, and then you have to just sit there and watch in frustration as it immediately turns around and rallies without you. The data is telling us this isn't just bad luck, it's a systematic pattern that grinds down your returns over time. Okay, now this part is absolutely critical. Before you go and cancel every stop loss order you have, we need to talk about some really important context. These findings are not a universal law that applies to everything. The research we've been looking at applies specifically to stocks and equity indices. The author is very, very clear that these tests were not run on options, futures, or Forex. Those markets have totally different dynamics, especially with leverage, and the role of a stop might be completely different, maybe even essential. So please do not generalize these results. And we also have to be real about the human element here. For a lot of traders, a stop loss isn't just a technical tool, it's a psychological safety net. It's the thing that lets them sleep at night knowing that their maximum risk is defined. And hey, if that peace of mind is what you need to stay disciplined and stay in the game, then that absolutely has value. But you should use them with your eyes wide open. You need to be aware of the trade-off you're making. While that stop might be giving you some much-needed psychological comfort, the data we just went through is pretty compelling. For stocks, that comfort likely comes at a real, measurable cost to your long-term performance. And that really brings us to the final question, doesn't it? It gets to the very heart of the conflict this research uncovered. In your own trading, which do you prioritize? Is it the psychological comfort of that safety net? Or is it the potential for higher returns that the data suggests might come from taking that net away? There's no single right answer for everyone, but knowing the trade-off, that's the first step to making a much smarter choice.
What if I told you that the single riskiest time to hold a stock is also the only time you actually make any money? It sounds completely backward, right? But it's a belief that so many traders get wrong. Today, we're going to dig into the hard data behind holding positions overnight, and I promise you, what we're about to see is going to challenge pretty much everything you think you know about market risk.
So here's our game plan. We're going to start by jumping back in time to a market that felt like a complete minefield. Then we'll look at the big choice every trader had to make. After that comes the bombshell, the actual data from the S&P 500 and the NASDAQ that just flips common sense on its head. And finally, we'll pull it all together to understand a powerful secret, the contrarian's edge.
All right, let's set the scene. Imagine you're trying to trade between 1995 and 2007. This wasn't just a little bit of a bumpy ride. For a lot of people, it really felt like you were walking through a minefield, where one wrong step could blow up your entire account.
I mean, just look at this list. It was a relentless series of gut punches. You had wars in the Middle East, the whole financial system nearly coming unglued with long-term capital management, the dot-com bubble completely imploding, the absolute horror of 9/11, massive corporate scandals like Enron, and then, to top it all off, the early rumblings of the housing crisis. It just never stopped. The market was constantly under attack.
And here's the kicker. So many of these huge, market-moving events happened while U.S. markets were closed. The bad news would break somewhere across the world, and by the time that opening bell rang at 9:30 a.m. in New York, bam, the damage was already done. So this really hammered home one big idea. Holding your stocks overnight was just pure gambling. So this whole environment creates a massive problem for every single trader. Put yourself in their shoes for a second. It's 1995. You know the next 13 years are going to be total chaos. You want to make money, of course, but you also really don't want to get wiped out. So what do? What's your move? With this constant threat of some disaster happening while you sleep, what's the most logical, the most common sense way to trade? How do you protect your capital? Well, it really boils down to two simple choices. Strategy number one is the play it safe route. You only trade when the market is open, you buy at 9:30 a.m., you sell before 4 p.m., and you get to sleep like a baby knowing you have zero risk overnight. Then there's strategy two, which is the total opposite. You embrace the risk. You buy at the close and sell the very next open, holding on for dear life through that whole dangerous overnight period.
So again, which one are you going to pick? I mean, for 99% of us, the answer seems like a total no-brainer. You avoid the risk, you trade during the day when you can actually see what's happening and react. It's the only sensible thing to do, right?
Well, about that logical choice, it turns out it's completely 100% wrong. Because in the markets, what feels safe and what's actually profitable are often two very different things. So you might want to brace yourself for this next part, because the data tells a story that you are probably not going to believe.
You know, the source material puts it perfectly. It says, when it comes to trading, the obvious answers are usually wrong. That safe path, the one that everybody would instinctively choose, was actually the most dangerous thing you could do for your portfolio.
Okay, so take a look at this chart. This is the S&P 500 from 95 to 2007, and it's broken down by those two strategies we talked about. On the left, you've got the risky overnight hold. On the right, you have the safe day-only trade. And the results, they're not just different, they are staggering.
Let's put a hard number on it. That so-called risky strategy of holding overnight, it didn't just squeak out a tiny profit. It netted a whopping 171.4 points. All that fear, all those scary headlines, all that perceived risk actually turned into a massive gain.
Now, for the part that's really going to blow your mind. That safe strategy, the one where you buy at the open and sell it to close to avoid all the drama,
It lost almost 71 points. You would have actively lost money by trying to play it safe.
Let that sink in for a second. The S&P 500 tripled in value during this time, and yet if you only traded during the day, you would have lost money. 100% of the market's gains, and actually, then some, came from that overnight period. The safe strategy didn't just miss the party, it actively set your portfolio on fire.
Now I know what you might be thinking. Okay, that's weird, but maybe it's just a fluke, some strange quirk in the S&P 500. And that's a totally fair question. So let's put this theory to the test with a completely different animal, the tech-heavy NASDAQ. And the answer is, yep, it's the exact same story. The same phenomenon happened in the NASDAQ 100. So this wasn't some isolated incident, it was a broad, undeniable market pattern. Here's the chart for the NASDAQ. Just looking at it, you can see it's basically a carbon copy of what we just saw. You've got this huge positive bar for the overnight strategy, and a deep negative bar for the day-only strategy. The evidence is just incredibly consistent. And the numbers confirm it. The overnight strategy for the NASDAQ gained over 99 points. Meanwhile, the safe day trading strategy lost more than 58 points. The pattern isn't just similar, it's practically identical. So the conclusion here is pretty much inescapable. For both of these major indexes, during one of the wildest times in market history, following conventional wisdom and avoiding overnight risk was a guaranteed way to lose money. And it really makes you wonder, doesn't it? Why? Is it because of earnings reports or things happening in overseas markets? It's a fascinating puzzle.
So what's the big lesson here? It's not really just about holding positions overnight. It's about a much bigger, much deeper principle for how to succeed in the markets. It's something we can call the contrarian's edge. Here's the core idea, and it's a powerful one. If it's logical and everyone is thinking the same way, it's not likely going to make money. What that really means is that by the time an idea becomes obvious to everyone, all the profit has already been squeezed out of it. The real advantage is found in doing the thing that feels a little uncomfortable.
And that, right there, is the contrarian's edge. It's not about just betting against the crowd for the sake of being different. It's a smarter, two-step process. First, you find a popular, common-sense belief. And then, this is the most important part, you use hard data to see if the total opposite is actually true.
So why does all this matter for you? Well, for one, it's proof that conventional wisdom can be seriously misleading. Two, it shows that your real edge is often hiding in strategies that seem unpopular or even a little scary. But most importantly, it's a huge reminder that data, not your gut feeling, not obvious logic, has to be what guides your decisions. You have to be willing to challenge what you think you know. And that brings us to a final question to leave you with. We just completely took apart the obvious belief that holding overnight is too risky. So I'll ask you, what other common sense, obvious market belief are you holding on to right now that might actually be costing you? Now that's something worth thinking about.
All right, let's get right into it. Today, we're going to tackle an idea in trading that is, well, it's completely backwards to how most people think. We're going to explore the concept that the moments of pure, unfiltered fear, when your stomach is in knots and every instinct is screaming sell, that those moments might actually be where the biggest opportunities are hiding. We're going to look at the data that suggests the smartest move is often to run toward the fire, not away from it. I love this quote. It's a little graphic, sure, but man, does it capture the spirit of what we're talking about today. It's all about being the person who's willing to step in and buy when everyone else is panicking, and then having the patience to sell it back to them when they're all excited and euphoric again. Sounds simple, right? But believe me, in the heat of the moment, it's one of the hardest things to do. So here's our game plan. First, we'll cover the core contrarian philosophy. Then, we're going to take a trip back in time to a very specific party on Wall Street. You'll see what I mean. From there, we'll dig into the data and bust the myth of momentum, which is going to lead us straight to the power of the pullback. We'll actually visualize the opportunity with a real chart, and then we'll wrap it all up with how you can build your contrarian edge. Okay, so let's start with the big picture. Markets tend to be pretty rational and efficient over long time frames, like years or decades. But the shorter you go, days, hours, minutes, the more that logic goes out the window. What takes over? Raw emotion, greed, fear, and that's where the chaos kicks in. And it's right there in that chaos that a smart trader can find a real edge. See, all that emotional decision-making means stocks can get way out of whack with their true value, at least for a little while. And this brings us to a super important concept.
mean reversion. The best way to think about it is like a rubber band. A stock's average price is its resting state. When people get super greedy, they stretch that rubber band way, way up. When they panic, they stretch it way, way down. Mean reversion is just the bet that eventually that rubber band is going to snap back. And that snap, that's our profit. To really get a feel for what peak greed, that rubber band stretched to its limit, looks like, we need to hop in a time machine. This is an absolutely perfect example of what happens when everyone gets caught up in the hype, and what it feels like to be the only person who sees a problem. Picture this. The date is July 17th, 2007. The Dow Jones Industrial Average just broke through 14,000 for the first time in history. The mood is electric. I mean, after years of a bull market, it felt like the good times were never, ever going to end. And if you flipped on the TV, it was a literal party. On CNBC, the hosts are actually wearing party hats on air to celebrate. Seriously, the source even mentions there were Victoria's Secret models on set for some other segment, which just added to this bizarre, surreal party atmosphere. Everybody felt like a genius. This was peak euphoria. So what happened next? Well, you can probably guess. That party. That was the top, the absolute peak, right before the whole subprime mortgage crisis blew up. Within just a year, the Dow had tanked over 3,000 points. Billions of dollars just vanished. It's a painful reminder, right? The moment of maximum excitement is almost always the moment of maximum risk. Now, that story is powerful, but anecdotes aren't data. So let's see what the cold, hard numbers have to say. We're going to run a test on one of the most popular strategies out there, momentum trading. You know, the idea of buying stocks that are already flying high, hoping they'll go even higher. Okay, so here are the rules for our first test. We're looking at data from 1995 to 2007. We find a good stock, one that's in a long-term uptrend, and just hit a 10-day high. Then, the very next day, we wait for it to push even higher, and we jump in, chasing that strength. We then hold it for 5 days and see what happens. Simple enough? And this is where it gets really eye-opening. The results systematically get worse and worse. If you buy the stock when it's just up 1% for the day, you basically break even, a tiny 0.02% gain. But check this out. The more you chase it, the worse you do. Buy it when it's already up 3%, and suddenly you're losing money on average. And if you buy that super hot stock that's already up 10% on the day, you're looking at an average loss of almost a full percent over the next 5 days. The more FOMO you feel, the more money you lose. So the takeaway here couldn't be more clear. Over hundreds of thousands of trades across more than a decade of data, chasing strength is, on average, a losing bet. It feels great in the moment, but the numbers just don't lie. So if buying into strength doesn't work, what does? Well, let's flip this whole thing completely on its head. Now we're going to test what happens if we do the exact opposite. What if we intentionally buy into weakness? So here are the new rules. It's a mirror image of the first test. We're still looking for good stocks in a long-term uptrend, but this time they've just hit a 10-day low. They're in a pullback, and our strategy is to step in the next day as the price drops even further. And again, we hold for 5 days. And the results? Oh man, it's like night and day. Buying a 1% dip intraday gives you a really nice average gain of 0.62%. But look what happens as the selling gets more intense. You buy a 3% drop, your return nearly doubles to 1.17%. A 5% drop gets you almost 2%. And what about those moments of pure terror? When a stock has plunged 10% in a single day, the average 5-day return is an incredible 4.35%. Just think about that. The scarier it gets, the bigger your statistical edge becomes. It's unbelievable. I mean, if the tables weren't enough, this chart just says it all. This is the difference between buying extreme greed and buying extreme fear. On one side, chasing a 10% rally gives you a negative return. On the other side, buying a 10% plunge gives you a massive positive return. The difference is just staggering. This is what a real data-driven edge looks like. Okay, the stats are amazing. But what does this actually look like in the real world? Let's step away from the numbers for a second and look at a real-life chart of one of these high-probability setups. All right, now look at the chart on the left. This stock is in an absolute free fall. That last bar is a massive, terrifying plunge. Who in their right mind would buy that? Your gut is probably screaming, no way. But now, look at the chart on the right. That's what happened just a few days later, a huge snapback rally. This is exactly what our statistics predicted would happen. That moment of peak fear was the moment of peak opportunity. And the source material just puts it perfectly here, saying that's why stocks like this provide outsized rewards to the smart money that steps in, because as the statistics bear out, this type of plunge often leads to moves like this. It's just a reminder that the so-called smart money is usually doing the complete opposite of what the crowd is doing. So let's pull all this together. We've seen the story, we've seen the data, we've seen what it looks like on a chart. So how do we take all this and turn it into a real principle that can actually sharpen our own thinking about the markets?
Here are the 4 big things to take away from all this. Number 1, short-term market chaos isn't just noise, it's what creates these opportunities in the first place. Number 2, the data is crystal clear. Chasing momentum is a weak strategy. Number 3, the real historical edge is found by doing the opposite, buying into weakness. And finally, number 4, your goal should be to change your entire mindset, to become the calm person who's willing to buy when everyone else is panicking and hitting the sell button. And if we boil it all down, it comes to this final choice. The path of greed is buying breakouts. It feels exciting. You're part of the crowd, but the data says it's a losing strategy. Then there's the path of fear. It's buying pullbacks when things look awful. It feels scary. It feels lonely. But as we've just seen, that is the statistically winning strategy. So I'll leave you with this final question to think about. The next time you see a sea of red on your screen, when the financial news is screaming sell and you can feel the panic in the air, are you going to see fear or are you going to see your edge?
If you've spent any time looking at stock charts, you've almost certainly heard of the Relative Strength Index, the RSI. It's everywhere. But what if I told you that the way most people use it is, well, fundamentally flawed? We're about to dive into the hard data to uncover a very specific tweak to the RSI that might just give you a real, provable statistical edge. So let's just cut right to the chase and ask the big question. Is this tool, this indicator that millions of traders trust every single day, actually leading them astray? Believe it or not, when you look at massive historical studies, the answer seems to be a resounding yes. It's really time we challenge some of that old conventional wisdom.
And this slide right here, this is the heart of the matter. On the left, you've got your standard 14-period RSI. It's the default setting on pretty much every platform out there. The problem? Study after study shows it gives you no real statistical advantage. But then, look to the right, the 2-period RSI. A much shorter, way more sensitive version. And as you're about to see, this is where the real predictive power is hiding.
Okay, so here's our game plan. First, we're going to bust the myth of that standard RSI. Then, we'll introduce this powerful 2-period alternative. We're going to back it all up with a mountain of evidence from over 8 million trades, then give you 2 actionable strategies you can actually use. And finally, we'll talk about the bigger picture, what all this means for finding a real quantitative edge in your trading. All right, let's tackle this myth head on. You see the 14-period RSI praised in trading books, on websites and forums, but you know what's funny? So few of those claims are ever backed up with actual, rigorous statistical testing. And when someone finally does crunch the numbers, the conclusion is pretty stark. That standard setting just doesn't deliver a reliable edge.
So, if the standard approach is a bust, where's the edge? Well, it turns out the secret is almost laughably simple. You just dramatically shorten the time frame. The research shows that as you start lowering that period from 14, the results get better and better. And the real sweet spot, the one that gives you some truly robust and consistent signals, is the 2-period RSI.
Now, before we go any deeper, let's do a super quick refresher on what the RSI even is. It's basically a momentum gauge. Think of it like a speedometer for stock prices. It measures how fast and how far prices have moved, and then plots it on a simple scale from 0 to 100. The whole idea is to tell you if a stock is overbought and maybe running out of steam, or oversold and possibly ready for a bounce.
Okay, now for the good stuff, the proof. And let's be clear, what we're about to look at isn't based on a few cherry-picked examples. This comes from a massive, comprehensive study that analyzed over 8 million trades spanning more than a decade from 1995 to 2007. This is the hard data talking.
So to know if our strategy is any good, we need something to compare it to, right? A benchmark. During that same 12-year period, what did an average stock do if you just bought and held it? Well, as you can see, the average gain over 1 week was a tiny 0.25%. That's our baseline. That's the number to beat. Let's see how our 2-period RSI stacks up. And boom, this is where the edge just becomes crystal clear. Check out these numbers for oversold stocks. When the 2-period RSI dropped below 10, the average return over the next week was 0.49%. That's almost double our benchmark. And look what happens as the RSI gets even lower. Below 5, you get a 0.62% gain. Below 2, it's 0.79%. And in RSI below 1, an incredible 0.93% gain, almost 4 times the average stock. The data couldn't be clearer. The more beaten down a stock is, the better it tends to bounce back. And guess what? The pattern is just as strong on the overbought side, but in the complete opposite direction. As that RSI number climbs higher and higher, the future returns just get worse and worse. Look at that 1-week column. An RSI above 90 is already leading to, on average, a negative return. By the time you get an extreme reading over 98, the average stock loses 0.19% over the next week. The message here is simple. Extreme short-term strength is a major warning sign. You know, if a picture is worth 1,000 words, this one is practically screaming. On the left, you see that powerful positive return, almost 0.8% when you buy stocks with an RSI below 2. And on the right, you see that negative return when stocks get an RSI above 98. The gap between buying the extreme low and shorting the extreme high is almost a full percentage point in just 1 week. That, my friends, is a massive, undeniable statistical edge. So let's see what this looks like on a couple of real charts, so it's not all just numbers. On the left, we've got Allegheny Tech. See that sharp little dip in the 2-period RSI, way down at the bottom? That's our oversold signal. And would you look at what happened to the stock price right after? A really nice rally. Now, look to the right at Monster Worldwide. It's the mirror image. The RSI spikes up to this crazy high overbought level, and what happens next? A steady bleed in the stock price. It's a perfect visual of this whole concept in action. Okay, so the evidence is pretty overwhelming, right? But data is just data. It's useless if you don't have a plan. So the big question is, how do we actually turn this insight into a repeatable, systematic process? Let's dive into 2 very distinct, very actionable strategies that are built on the power of this 2-period RSI. All right, this first strategy is just beautifully simple. It's focused specifically on the S&P 500 index, so it's perfect for anyone trading SPY or futures. Now, it only has 4 rules, but get this. Historically, it has been right about the short-term direction of the market an absolutely incredible 83.6% of the time. Okay, here are the nuts and bolts. Rule number 1, we only want to buy when the overall market trend is up. So, the S&P 500 needs to be trading above its 200-day moving average. Simple. Rule 2, this is our trigger. The 2-period RSI has to close below 5. That's our extreme oversold signal. Rule 3, you buy right on the close of that day. And Rule 4, the exit is just as simple. You sell when the S&P closes back above its short-term 5-day moving average. That's it. Simple, clear, and proven to be effective. Now for something a bit more advanced. This strategy is called cumulative RSIs, and for a long time, it was a technique that was only shared with a pretty small circle of professional traders. The core idea here is to look for sustained weakness, not just a one-day dip. We're actually going to add up the RSI readings from the last couple of days to get a cumulative score. So the rules here start off familiar, but there's a key twist. First, just like before, we want to be in a long-term uptrend. And yes, we're still using our trusty 2-period RSI. But here's the big difference, the entry. Instead of just one reading below a certain level, we sum the RSI readings over, say, the past 2 or 3 days. If that total sum is below a super low threshold, that's our signal to buy. Then, we hold on until the 2-period RSI finally bounces all the way back up and closes above 65. And the results of this cumulative approach? They are absolutely fantastic. Looking at the SPY ETF, if we used a simple 2-day sum and bought any time that total was less than 35, the historical win rate was an amazing 88%, with an average gain per trade of over 1.2%. But what's really cool is how robust it is. If you loosen the rules a bit, say you raise the threshold to 50 to get more trades, the win rate still holds incredibly strong at over 85%. That just proves how powerful the core concept really is. So we've gone deep into the data, we've looked at a couple of powerful strategies, but the real lesson here is actually much bigger than just one indicator. This is about an entire philosophy of trading. It's about what it truly means to find a quantitative edge. This quote from the original source material just nails it. Proper trading isn't about gut feelings. It's not about hot tips from some guru, and it's definitely not about following the crowd. It's about basing your decisions, your hard-earned capital, on cold, hard, quantitative research. It's about knowing the odds before you even think about clicking that buy button. And really, that's the whole point. When you take a data-driven approach, you get to step away from all the emotion and the ego that messes traders up. You can look at any potential setup and objectively ask, based on history, does this trade offer a good risk to reward? And if you have the data to answer that question, you have a real definable trading edge. And that really leads us to the final big question I want to leave you with. We've just seen how one of the most common pieces of trading wisdom, the 14-period RSI, completely falls apart under real statistical scrutiny. So it has to make you wonder, right? What other trading rules or indicators that we all just take for granted should be put to the exact same rigorous, data-driven test? All right, today we're diving into a trading strategy that's so simple you could probably jot it down on a napkin. But don't let that fool you, because it comes with a pretty wild claim of success. It's called the double seven strategy. Okay, so let's just get right to the heart of it. Here's the big question. Can a strategy with only 3 rules, just 3, actually predict which way the market is going to go and be right over 80% of the time? I mean, that sounds almost too good to be true, right? So in this explainer, we're going to dig in and see what's really going on here. So here's our game plan. First, we'll look at this unbelievable claim and the idea behind it. Then we'll reveal those 3 simple rules that are at the very core of this thing. After that, and this is the fun part, we'll look at the data from the US market, see if this holds up in other countries, and finally, we'll talk about the hidden power of keeping things simple. Okay, so the entire strategy, the whole thing, is built on this one idea that might feel a little, well, backwards. The source material claims that based on tons of historical data, markets actually tend to do better after a pullback, a short-term dip in price, not after they break out to new highs. This is the key concept you got to get your head around before we even look at the rules. And that brings us to the star of the show, the double sevens strategy. Really all it is a super simple rule-based system. It's designed to do one thing and one thing only: take advantage of those short-term market dips. There are no fancy indicators, no gut feelings, just a clear set of instructions. All right, the moment you've been waiting for. What are these 3 simple rules? Let's pull back the curtain and reveal the so-called secret behind the strategy. This is where you'll really see just how simple we're talking. And here they are, just 3 steps. That's it. First, you need to make sure the overall market trend is up. So the strategy only even looks for trades when the SPY, that's the big S&P 500 fund, is trading above its 200-day moving average. It's like making sure you're swimming with the current. Rule number 2, if the SPY closes at a 7-day low, that's your signal, you buy. And finally, rule number 3, if the SPY then closes at a 7-day high, that's your cue to get out, you sell. The whole logic is just wait for the big trend to be up, buy the small dip, and sell the small rip. And this chart right here, this shows you exactly what that looks like in the real world. You can see it clear as day. That first point marks a 7-day closing low, that's the buy signal. Then, just a handful of days later, boom, at point 2, the market hits a 7-8 closing high. That's your sell signal. It really helps make those rules feel a lot more real. And I know exactly what you might be thinking right now, because the author calls it out directly. Is that really it? It just feels way too simple, doesn't it? Especially for something as complicated as the stock market. But the whole point the author's making is, hey, let's stop guessing and just let the data do the talking. So it's time to do just that. Let's let the data speak for itself. We're going to see how this shockingly simple strategy actually did in historical tests, starting right here in the major US markets. This is where the rubber meets the road. Okay, here are the numbers for the S&P 500 ETF, the SPY, all the way from its start in '93. The data showed 153 trades, and the average profit was about 0.85% per trade. But the number that really makes you sit up and pay attention is over in that percent correct column. Let's just put that number on its own for a second. 80.4%. I mean, think about that. According to this data, more than 4 out of every 5 trades were winners. This is the stat that's behind that incredible claim we started with, and honestly, that is a sky-high number for any trading strategy. But here's what might be even crazier. The strategy's efficiency. It wasn't in the market all the time, chasing every little move. Nope, it was invested less than a quarter of the time. And yet, in that short window, it apparently managed to capture all of the S&P 500's gains over that entire period. It was basically surgical, getting in for the upswings and sitting on the sidelines for everything else. Okay, but maybe that was just a fluke, right? Some weird thing with the S&P 500. While the author then took the exact same rules, no changes, and applied them to the NASDAQ 100. And as you can see, the results are, well, they're pretty darn similar. The average gain per trade was even a little higher. And would you look at that win rate, 79.4%. Again, we're right back in that same ballpark, just shy of 80%. When you see that kind of consistency across two totally different major U.S. indexes, it starts to suggest that the basic idea, buying short-term dips in a long-term uptrend, might actually have some teeth to it. So the strategy seems to work pretty well in the S&P 500 and the NASDAQ. But what about outside the U.S.? I mean, is this just an American market thing, or does this simple logic actually hold up on a global scale? Well, they decided to test that too. First up, China, using their main ETF. Now, the test period is a bit shorter, so there are fewer trades. But look at the average profit, a whopping 1.41% per trade with a win rate of almost 77%. The strong performance just keeps on coming. Okay, how about we try an emerging market, like Brazil? Looking at their ETFs from the year 2000, the results reported are, well, even more impressive. The data showed 63 trades with a massive average profit of 1.82% for each one. And there it is again, the win rate for the Brazilian market, 81%, right back over that 80% line we've been talking about. You know, seeing the same pattern pop up over and over again, from the US to China to Brazil, that's what makes you think there's something genuinely powerful about the principle at work here. So after all that data, what's the real lesson? What's the big takeaway? The author argues it's not actually about the number 7 or even this specific set of rules. The data is really just there to prove a much bigger point about the incredible power of keeping things simple. And this is a really key detail. This strategy isn't fragile. It's not a magic trick that only works with the number 7. The author points out that the same logic works really well if you use double 5s or double 8s. The number isn't the secret sauce. It's the underlying principle. Buy the dip in an uptrend that appears to be so robust and strong. And all of this leads to some direct, practical advice. Be wary of complexity. When you see a trading strategy with a million different rules and filters, you should get a little nervous. A lot of the time, a system like that is overfit, meaning it's been so perfectly fine-tuned to past data that it looks amazing on paper, but it completely falls apart in the real world. You know, this idea is anything but new. The author digs up this fantastic quote from a Spanish philosopher, Baltasar Gracian, written over 300 years ago. If brief, good. If briefer, better. It's just this timeless piece of wisdom that perfectly captures the whole argument here. Simplicity and effectiveness often walk hand in hand. So what's the big lesson here for all of us? Whether you're a trader or not, the core message is powerful. In a world that is constantly pushing for more complexity, more data, more bells and whistles, sometimes the biggest, most powerful advantage you can find is just stripping things down to what really matters. Simplicity can be a real edge. And that leaves us with one final thought to chew on. In our modern world, with its high-frequency trading and mind-bendingly complex algorithms, is it possible, just possible, that the most powerful and most overlooked advantage of all is just elegant simplicity? You ever hear those rumors on Wall Street, the ones that traders kind of whisper about? Well, one of the biggest is that stocks just seem to do better at the end of the month. It's like clockwork. So today, we're going to stop whispering. We're going to dig into the hard data and see if there's a real statistical anomaly hiding in plain sight on the calendar. So where did this idea even come from? Well, a lot of it traces back to a market veteran named Kevin Haggerty. This guy was the former head of trading for Fidelity Capital Markets. I mean, he had a front row seat to how the market really works. And when someone like that, with that kind of experience, notices a pattern, you pay attention. And that brings us to the big question for today. Is this end-of-the-month effect for real, or is it just a myth? Is there an actual, provable upward bias for stocks as the calendar flips over? Well, we are going to find out. Here's how we're going to break it all down. First, we'll dive into the rumor itself. What's the story behind it? Then we'll get our hands dirty with the data and establish a baseline. From there, we'll see if we can fine-tune things to find an even better entry. Then we'll uncover what the research calls an extreme anomaly. And finally, we'll wrap it all up into a clear potential strategy. Okay, let's start with the rumor. What are traders actually talking about here? Let's get to the bottom of the theory. The core idea is actually pretty simple. Think about it. Every single month, a giant wave of cash from our 401ks, retirement plans, and all sorts of other savings floods into the market. The theory is that the big shot fund managers, they know this money is coming, so they start buying stocks a little early, late in a month, trying to get ahead of that huge inflow. All of that predictable buying could, in theory, create a little upward drift in prices. Now, to test this, the researchers didn't mess around. They analyzed a massive data set. We're talking over 8 million trades, spanning a full 13 years. So this isn't about hunches or anecdotes. This is about putting the theory under a powerful statistical microscope to see if it holds up. So before we can find an anomaly, we need to know what's normal, right? The researchers first had to establish a baseline. They asked a simple question. If you buy a stock on any random day and hold it for 5 days, what happens? What's the average outcome? Now, they did set some ground rules. They only looked at stocks that were already in a healthy, long-term uptrend, and they had to have decent trading volume. Under those conditions, the average gain for any random 5-day hold was just 0.25%. Okay, remember that number, 0.25%. That's our yardstick. Okay, now let's look at the actual results for the first half of the month. Right away, something really interesting pops out. Look at this. From day 3 all the way through day 8, the average 5-day return is actually negative. The data suggests there's this consistent patch of weakness right after a new month kicks off. But now, let's look at the second half. It's like the entire picture just flips on its head. As we get closer to the end of the month, the returns start climbing. Day 23, the gain almost doubles the baseline. Day 24, it more than triples. And then, things get really interesting on the 25th. And here is where it gets truly remarkable. Look at the difference here. The average gain from buying on the 25th was a stunning 1.23%. That's not just a little better. It is nearly 5 times the baseline average. The data is practically screaming that there's a powerful upward bias right at the end of the month. Okay, so we've found a really strong effect just based on the calendar. But the researchers, they got curious. They thought, can we do better? Could we add another filter to make this anomaly even stronger? So they asked a really smart question. What if we only buy these strong, uptrending stocks on those powerful end-of-month days, but we do it after they've had a little dip? What happens if we specifically look for a pullback? And the results were fascinating. By adding this simple filter, only buying these strong stocks after just a single down day, the end-of-month returns got even stronger. Look at the numbers for days 24, 25, and 26. They all improved over our first test. The effect was getting amplified. It suggests that buying on weakness, but only during this specific time of the month, is a really powerful combination. Let's just put it side by side to see it clearly. Buying on the 25th of the month already gave us a fantastic 1.23% average gain. But buying on the 25th after the stock had one down day, that boosted the average all the way up to 1.42%. You can see the edge is getting sharper and sharper. This led the researchers to push it just one step further. If a 1-day pullback helps, what about a 2-day pullback? And this final filter is what uncovered a truly extreme statistical anomaly. Just look at this number, 1.53%. That is the average 5-day gain you get when you combine all the factors, buying a strong uptrending stock on the 25th of the month, but only after it has fallen for 2 days in a row. And when you apply this 2 down days filter across the whole month, the data becomes undeniable. The returns toward the end of the month aren't just a little bit better, they are consistently and significantly larger than anything we saw before. This wasn't a 1-day fluke, it was a clear, powerful pattern. Let's zero in on the best of the best days here. You've got an incredible cluster of strength. Days 24, 25, 26, and even day 30 all show average gains over a full percent. And on that monster day 25, not only is the gain that incredible 1.53%, but the win rate, the chance of the trade being profitable, was around 60%. That is a powerful, persistent edge. So, we have just waded through a ton of data. What does it all mean in the real world? How can we translate all this research into something practical? Well, a clear, rules-based strategy starts to take shape. Here it is, broken down into 4 simple steps. Step 1, you only look at healthy stocks that are already in an uptrend. Step 2, you gotta be patient and wait for the calendar to hit that sweet spot in the last week of the month. Step 3, within that group, you hunt for the ones that have shown some short-term weakness, a pullback of 1 or 2 days. According to this research, that exact combination is the historical sweet spot. And this brings us right back to that original theory, doesn't it? The data seems to tell the same story. Not only do fund managers appear to be buying at the end of the month, but the fact that the results get so much better after a pullback suggests they're bargain hunters. They're stepping in to buy great assets when they go on sale right before a flood of new money comes in. But, and this is a really big but, that leaves us with one final crucial question. All of this powerful data is from a period that ended in 2007. The markets today are a completely different beast, run by algorithms and high-frequency trading. So does an anomaly based on the predictable flow of human savings still hold up in our modern high-speed digital world? Now that is something to think about. Welcome to The Explainer. Today we're going to tackle one of the most tempting and, let's be honest, dangerous ideas in finance: timing the market. We're breaking down 5 strategies to time the market, a guide that makes a bold claim that it is possible, but only if you follow very specific data-driven rules. And our story, interestingly enough, begins not with a brilliant success, but with a huge mistake that actually changed everything. Okay, so here's our game plan. We're going to start with that big, costly mistake and the incredible breakthrough it led to. Then we'll get into the weeds and dissect 4 very different rule-based strategies, looking at their logic and, of course, how they performed. And finally, we'll zoom out and uncover the single, powerful principle that ties them all together. So let's set the scene. We're going all the way back to 1995. The author was digging into the VIX, what pretty much everyone now calls the market's fear gauge. Back then, though, it was still kind of obscure, and his first attempt to build a strategy around it was, well, let's just say it was deeply, deeply flawed. It takes some serious guts to admit you're dead wrong, especially when you're one of the first people to really try and apply an indicator like the VIX to market timing. He realized his entire model was basically built on a foundation of sand. But this mistake, this failure, is exactly what sets the stage for a truly crucial lesson in trading. So, what was the big mistake? Well, it was all about treating the VIX as a static indicator. The idea seemed simple enough. If fear gets above a fixed number, say 13, you buy. If it gets below a number like 9, you sell. The problem? The market's baseline level of normal is always shifting. What was considered high fear in one year could be totally normal in another. And here is a perfect, almost painful example of how disastrous this static thinking can be. There used to be this popular rule floating around: short the market whenever the VIX drops below 20. And for a while it worked. But then, from 2003 on, the VIX just hung out below 20 for nearly 5 years straight, while the market ripped higher. Following that static rule would have been absolute financial torture. So out of all that pain came this light bulb moment, this core epiphany. You have to treat volatility indicators as dynamic. Their meaning isn't about hitting some magic fixed number. It's all about how their current level compares to their own recent behavior. This one idea is the bedrock for all the successful strategies we're about to look at. So let's jump into our first strategy and see exactly how this dynamic principle gets put to work. This one's called VIX stretches, and it's all about looking for those moments when fear gets stretched way out like a rubber band relative to its recent average. Okay, so here are the precise mechanical rules. First, and this is absolutely key, you only even think about buying when the market is already in a long-term uptrend. Then you wait for the VIX to be not just high, but stretched significantly above its own 10-day moving average for at least 3 days straight. That's a sign of sustained, but probably temporary, panic. The buy is on the close, and the exit is just as methodical. So how did it actually do? Well, the back-tested results from 95 to 2007 are pretty darn striking. Now, it's a very selective strategy. We're only talking 33 trades in 12 years. But man, when it triggers, the win rate is incredibly high. And with a hold time of less than a week, it's a perfect example of a very specific high-probability setup. I mean, just let that number sink in. We're talking about a strategy where almost 85% of the time it triggered, it was a winner. It just goes to show the power of being patient and waiting for a very specific statistically backed pattern instead of just, trading on a gut feeling. Okay, let's actually see what this looks like on a chart. On the left, you can see the setup on the VIX. See how those price bars are consistently stretched way above that squiggly 10-day moving average? Well, when that condition is met, it triggers the buy signal over here in the S&P 500 on the right,
aiming to catch that quick snapback rally that so often follows these moments of intense fear. All right, strategy number 2 takes this idea and adds another layer, kind of like a confirmation filter. The goal here is to pinpoint those moments of extreme short-term panic with even more accuracy. And it does this by combining the VIX with another really powerful tool, the RSI, or Relative Strength Index. So I want you to think of this one as waiting for a perfect storm of conditions. First, the big picture trend has got to be bullish. Market's above its 200-day average. Check. Second, you need a massive short-term spike in fear, and we measure that by the VIX's RSI screaming above 90. Third, you want to see that fear is still building. And finally, all that panic needs to have actually shoved the stock market itself into an oversold condition. When all 4 of those things line up, that is your signal to buy. Now, what's interesting here is that this one triggers way more often than the first one, with 92 signals over the same time frame. The win rate is still incredibly strong, close to 80%, and the total S&P points it captured is just massive. It really is a testament to the power of layering conditions to find these really robust entry points. Wow, I mean, the sheer volume of S&P points gained here is what really jumps out at you. It's just a powerful illustration that buying when short-term panic is at its absolute peak and confirmed by multiple indicators can be an incredibly profitable way to trade, especially when you have a disciplined exit plan. Okay, on to our next strategy. This one tackles a classic indicator, the TRIN, which you might also know as the ARMS index. It's one of those things that traders love to talk about, but very few have actually put in the work to see if there's a real, quantifiable edge there. Well, this strategy does exactly that. So the TRIN, in a nutshell, measures internal selling pressure by looking at advancing versus declining stocks and their volume. A high reading suggests there's a lot of panic selling going on. So yeah, it's a famous indicator, but the real question is, does it actually work? Can you build a reliable system around it? All right, so here's the system. And you'll probably notice a theme here. First, we confirm the main trend is up. Then we wait for the market to get a little weak. But the real trigger is seeing 3 straight days of intense internal selling, measured by the TRIN closing above 1.0. The whole idea is that after 3 days of this kind of pressure, the sellers might just be exhausted, creating a potential turning point. And what do you know? The results are pretty solid. A win rate over 75% and a very healthy number of S&P points gained. What's really impressive, though, is that because of that 200-day moving average rule, this strategy actually made money during the brutal 2000-2002 bear market by mostly staying out and only picking its spots very, very carefully. All right, our final strategy introduces a really cool concept, the cumulative RSI. The whole point here is to find a market that is so deeply and persistently oversold that there are basically no sellers left, creating that classic washed-out condition that's just ripe for a reversal. And you know what? The logic here is just beautifully simple. First, confirm the long-term uptrend is still intact. Then, instead of just looking at one day's RSI, you add up the readings from the last 2 days. If that combined sum is crazy low, it's a signal of a multi-day momentum washout, and that is the trigger to get in. And surprise, surprise, the data shows this simple idea has been incredibly effective. A win rate knocking on the door of 80%, and another massive haul of S&P points. It just reinforces this idea that in a bull market, buying those deep multi-day pullbacks has historically been a very, very powerful strategy. Okay, so we've been deep in the weeds looking at 4 different strategies, using 4 different sets of indicators. Now it's time to zoom out and see the forest for the trees. This right here is the real wisdom, the big idea that connects everything we've talked about. It turns out, all 4 of these winning strategies are really built on the exact same foundation, the same 4 pillars. First, swim with the current, don't fight the main trend. Second, be patient and wait for true extremes, because the middle of the range is just noise. Third, remember that first lesson, think dynamically, not statically. And finally, know your exit before you ever get in. Trading without a clear exit plan isn't a strategy, it's a wish. So this all leaves us with one final and I think pretty powerful thought. The specific indicators, the specific numbers, might change over time, but these core principles, trading with the trend, buying dynamic extremes, they're timeless. So the real question isn't about the past, it's about the future. How will you apply this framework to identify and prepare for the unique market extremes of tomorrow?
All right, welcome to The Explainer.
Today, we're diving into something that honestly might be the single most important skill in trading, but it's the one almost everyone overlooks. We're talking about knowing exactly when to sell.
You know, there's this great old joke from comedian Henny Youngman, and it just hits the nail on the head about a fundamental market truth. It's so easy to get all excited about buying something when it's going up, right? But the hard part, the thing that really separates the pros from the rest of us, is knowing when to sell and making sure there's actually someone there to sell it to when the time is right. And that's the core issue, isn't it? I mean, think about it. Financial news, social media, your buddy at work, everyone's got a hot tip on what to buy. But clear, solid advice on when to get out? That's way, way harder to find. Well, in this explainer, we're going to change that. Okay, so to really grasp just how powerful a great exit strategy is, I want to tell you a story. And this one, it completely flips conventional trading wisdom right on its head. It shows a secret to success that has almost nothing to do with finding that perfect moment to buy. So let me ask you this. Just think about it for a second. Do you think it's possible to make 7 figures a year, consistently, from trading, even if your actual entry signals, your method for picking when to buy, is a statistical loser? I mean, that sounds impossible, right?
Well, believe it or not, there's a professional trader on the Chicago Mercantile Exchange who does exactly that. And his success holds a seriously powerful lesson for every single one of us.
So let's really dig into this, because it's wild. This guy is consistently pulling in 7 figures a year trading E-minis. But here's the kicker. When people rigorously backtested his entry methods, they found no statistical edge. Zero. In fact, some of the tests actually showed a negative edge. It's like he was starting every single race from behind the starting line. So how on earth is he so successful? You guessed it. It all comes down to one single thing, a superior, almost instinctive exit methodology. He just has this incredible feel for when the market is topping out and it's time to cash in. His genius isn't in buying right, it's in selling perfectly. This story really proves that your exit strategy can be so powerful that it can turn a losing entry system into a money-making machine. Now, look, most of us don't have that kind of psychic, instinctive feel, right? So we need something more concrete. We need a structured, rules-based approach. And that's exactly what we're going to do in this next section. We're going to build a professional toolkit with 5 distinct data-backed exit strategies you can actually use. First, let's start with a guiding principle. This is old saying from market makers, feed the ducks when they're quacking. So what does that mean? It's simple, really. You sell when demand is high, when there's a ton of excitement, when all the buyers, the ducks, are loudly quacking for your shares. In other words, you sell into strength, not into weakness. This idea is the foundation for all the best exit strategies. Okay, so here's the game plan. We're going to cover 5 different strategies. We'll start with the simple stuff and then get into the more dynamic methods that adapt to what the market's doing. We've got the fixed time exit, the first up close exit, new high exit, moving average exit, and finally, the RSI exit. All right, strategy number 1, the fixed time exit. This one's about as simple as it gets. You just decide up front, I'm going to sell this thing in 3 days, and you stick to it no matter what happens. The good thing is, it totally removes emotion. The bad thing, it's completely rigid. It doesn't care at all what the market is actually doing. Okay, next up is the first up close exit. This is a classic method, and it comes from the legendary trader Larry Williams. The idea is this. After you buy a stock that's been beaten down, you just hold on until you get the very first day that it closes in the green. That's your signal. A little bit of strength is returned, and it's time to sell into that initial bounce. Strategy number 3 is the new high exit. And this one lines up even better with that feed the ducks idea we talked about. With this method, you don't sell until the stock closes at a new high for a specific period, let's say a 7-day high. You're basically waiting for clear proof that the buyers are in control before you decide to get out. All right, now we're getting into the more dynamic strategies, and this is where things get really interesting. The moving average exit isn't based on a fixed number of days or a specific price. Instead, it uses a moving average, which is just the average price over a set period, as a constantly adapting trigger. This is so powerful because your exit point literally adjusts every single day based on what the price has been doing recently. So, how does this actually work? Well, a really common rule is to sell your position the first time the price closes above the 5-day moving average. A trader with a slightly longer time frame might use the 10-day.
The whole point is to get you out of the trade right as that upward momentum starts to peak.
And that brings us to our fifth and final strategy, the 2-period RSI exit. Now, RSI stands for Relative Strength Index. The best way to think of it is like a momentum gauge. It measures the speed and change of price movements to tell you if a stock is getting overbought or oversold. Using a really short-term 2-period RSI is an incredibly sensitive way to pinpoint the exact moment a quick bounce is starting to run out of gas.
And just like with the moving average, you set specific trigger levels. A really common rule is to sell when that 2-period RSI closes above a certain number, like 65, 70, or even 75. When it hits that level, it's basically screaming at you that the stock has gotten very strong very fast, and it's the perfect time to feed the ducks and lock in those profits.
Okay, so we've laid out 5 different strategies. But talk is cheap. The real question is, which ones actually work the best? Let's put them to the test and look at the hard data from a massive backtest of over 63,000 trades. Let's see what the numbers say.
Wow, okay. The trend here is it's impossible to ignore. Just look at that column for average percent profit per trade. A simple one-day hold gets you just over 0.5%. Not bad, but look what happens when we move down to the dynamic exits. The moving average and RSI strategies, they're delivering profits that are getting close to 3% per trade. That's more than 4 times better than just holding for a fixed amount of time.
And this chart just makes it so visually obvious. You can see that massive leap in performance. I mean, the data couldn't be clearer. Dynamic exits that are designed to sell into strength, like the moving average and RSI strategies, they don't just beat the fixed time-based exits. They absolutely crush them.
All right, before we wrap this up, there's one more thing we have to talk about. It's kind of the elephant in the room. When a lot of people hear exit strategy, their mind immediately goes to trailing stops. Setting an order to automatically sell if a stock drops a certain amount from its peak. Sounds like a smart way to protect your profits, doesn't it?
Well, this is where the data might really surprise you. The common belief is that trailing stops are this essential tool for protecting your gains. But the reality, according to hundreds and hundreds of tests on these kinds of short-term trades, is the complete opposite. Stop strategies consistently made performance worse. Why? Well, they often get you shaken out of a trade by normal, everyday market noise, right before the stock makes its real move higher.
So, if there's one thing you take away from all this, let it be this. Your exit is not an afterthought. It's a fundamental, co-equal part of your entire trading plan. Selling with discipline is every bit as important as buying right. And as we saw with that CME trader, maybe, just maybe, it's even more important.
And that really leaves us with one final, crucial question for you to think about. We all spend so much time and energy analyzing charts, reading news, trying to find that perfect entry point. But is your exit strategy just as researched? Is it just as rules-based? And are you just as disciplined about it? Because as the data clearly shows, that's very likely where your real edge is hiding.
All right, let's get right into it. When you first get into the markets, you're led to believe that it's all about finding some secret code, right? The perfect indicator, the flawless algorithm, that one magic bullet that's going to give you an edge. But here's the hard truth. The thing that really separates the pros from everyone else. All the best strategies in the world, they're completely useless without mental strength. The real battle, the one that actually decides if you win or lose, isn't fought on your charts. It's fought right here, in the 6 inches between your ears.
So here's what we're going to cover. Think of this as a battle plan for that inner war. First, we're going to lay out exactly why your mind is a real battlefield. Then, and this is where it gets really interesting, we're going to turn to a totally unexpected source for our training manual, the world of the Navy SEALs. Yeah, seriously. These are guys who master life or death decisions under unbelievable pressure. We'll dive deep into their core philosophy, this powerful not dead, can't quit mindset. After that, we'll translate it all into a practical, tactical framework you can start using today. And we'll finish up with a simple 3-question gut check to see if you're really ready to win this thing.
And this quote, this really sets the stage for everything. It's from Richard Makowicz, the former Navy SEAL we're going to be learning from. In trading, what's the weakest path? It's taking the easy way out. It's breaking your own rules because you got scared. It's chasing some hot stock you didn't even research. It's blaming the market for your own screw-ups. This quote is a huge reminder that this whole game isn't about outsmarting the market. It's about conquering that little voice inside you that wants to take shortcuts.
So let's really explore this internal battlefield. In any elite field, you need 2 basic things. You need the technical skill, right? For a trader, that's your strategy.
but you also need the mindset to execute that skill perfectly when the pressure's on. And honestly, that's where most people fall apart. Having a great strategy without the discipline to follow it, it's like owning a Formula One car, but not knowing how to drive. You've got all this horsepower, but it's totally worthless when the green light flashes.
You know, what's funny is how obvious this sounds, yet how few people really let it sink in. Of course, it's easy to click buttons and feel like a genius when the market's going your way. But what about when chaos hits? What happens when a surprise headline drops and the market just dives? When volatility goes crazy and your perfect plan is suddenly garbage? Those are the moments that define you. Your ability to stay calm and disciplined when everything is on fire is pretty much the biggest predictor of whether you'll make it in the long run.
Okay, so let's make this personal. Right now, do you have a written step-by-step plan for these nightmares? I mean, picture it. You're in a brutal 8-day losing streak. The doubt is eating you alive. What does your rulebook tell you to do? Or this one, you fat finger a trade, a misclick. You just bought 1,000 shares instead of selling. You're down big instantly. What's your pre-planned response? Or how about that brand new strategy you backtested for months? It's bleeding cash from the very first trade. Do you bail? What's the protocol? If you're hesitating to answer these, it means you'd be making it up as you go along, under max stress. And that is a recipe for disaster.
And that brings us to this critical shift in thinking. You have to redefine your job. You are not in the business of predicting the future. You're not really a trader. You are a professional decision maker. The market is just the arena you play in. Your whole job is to make good decisions based on probabilities and then execute them without fear or greed getting in the way. The more you can plan those decisions ahead of time by creating strict rules before you're even in a trade, the safer you'll be from your own emotions. Period.
Okay, so if we all agree this is a game of making perfect decisions under pressure, where the heck do we learn to do that? We're not going to look at another trading book or Wall Street guru now. We're going to turn to a world where a bad decision doesn't just lose you money, it can get you and your team killed. We're going to learn from someone who had to make perfect choices when the stakes were literally life and death.
And this is our guy, Richard Mochowitz, a retired Navy SEAL who spent a decade at the absolute tip of the spear. Just think about the environment. Total exhaustion, spotty intel, and a situation where 1 second of hesitation could be fatal. In SEAL training, they are systematically torn down and then rebuilt for one main reason: to make perfect, calculated decisions in the total chaos of battle. That's the mindset we're here to steal and apply to our own battlefield.
So let's get into the core philosophy here. This is the foundation that everything else is built on. This isn't just about being disciplined. It's about systematically forging a will to win that's so deep inside you that it becomes unbreakable no matter what the market, or life for that matter, throws your way.
Mock just boils everything down to this one brutally simple question. It's not about how smart you are or where you came from. It's about your absolute raw desire to keep going when everything in your body is screaming at you to stop. So do you just kind of want to be a successful trader, or have you made the decision that you will be one and that no amount of pain or failure is going to stop you? There's a huge difference.
And this is a perfect picture of that war going on in your head. That voice that wants you to quit, man, it's a smooth talker. It's not going to yell, "I'm scared." It's going to whisper things that sound smart, like, "Well, this strategy is clearly broken," or "The market's changed, my rules don't apply anymore." It's seductive. But the other side, the decision to keep going, that's simple. It cuts through all the noise. It's a binary choice. You're either moving forward or you're not. There's no in between.
This is the quote Match carried in his wallet until it fell apart. And this idea, it just radically simplifies the entire game. It destroys every single excuse. Think about it. You're in a massive drawdown. You're terrified. You just ask yourself 2 questions. 1, have I given up? No. 2, am I dead? No. Well, then the only logical conclusion is that I can still take the next right step. It makes the choice crystal clear, even when your mind is foggy with panic.
And there it is, the mantra that ties it all together. Not dead, can't quit. It's not a suggestion, it's a law. As long as you're still breathing, you have the ability to take one more step. This isn't about being reckless. It's about understanding that you can't be beaten unless you choose to quit. This is the absolute foundation of that warrior mindset.
All right, so we've got the mindset down. But a mindset isn't enough on its own. A warrior doesn't run on motivation. They run on procedure, on protocol. So let's shift from the why to the how. We're going to break down a simple, practical framework you can use to bring total clarity to what you're doing, especially when the pressure's on.
Mock calls this the combat play dynamic. It's a super clean 3-step process for getting anything done, and the order is everything. Target, then weapon, then movement. See, most traders get this backward. They just focus on the movement, buying and selling like crazy, without a clear target or the right weapon for the job. Once you get crystal clear on your target, the right strategy, and the right action, they almost become obvious.
And what's so cool is how perfectly this military framework fits into trading. For a SEAL, the target is the mission. For you, the trader, your target could be something like execute my plan perfectly for the next 10 trades. The weapons for a SEAL are their skills, their gear, their team. Your weapons, they're your trading strategies, your charts, and most importantly, your risk management, your stop losses. And finally, the movement. For a SEAL, that's the actual assault. For you, it's the simple, disciplined act of clicking the mouse. Enter, exit. And don't mess with it in between.
So here's the key to using this. Your big mission might be financial freedom, but you can't focus on that during the day. It's too huge. A SEAL's mission is to take a compound, but their first target is just getting over the wall. Then the next target is the door. For you, this means your only target is to execute this one trade perfectly. That's it. Identify the setup, place the order, set the stop. Done. Nail that one target, and it sets you up for the next one. That's how you kill the chaos, by only focusing on the very next step.
Now, this is all about that final step, the movement, and it's where so many people freeze. We've all been there, right? You see the perfect setup. Your plan is screaming, go! But you hesitate. You wait for just a little more confirmation, and in that tiny little pause between decision and action, all your fear and doubt rush in. That hesitation is fatal in trading. The goal is to make that gap disappear. See the target, select the weapon, execute the movement. Now, not in 1 minute, now.
Okay, let's bring it all home and make it personal. You can have the best mindset and the best frameworks in the world, but they're useless if you aren't truly committed. So Mod came up with this 3-question gut check, and you've got to be brutally honest with yourself here. If you can give a deep, genuine yes to all 3, then you've got the raw material to succeed at pretty much anything.
First question, are you willing to make a choice? We're not talking about choosing pizza over tacos. This is a real, committed decision to go down a path that will make you better. It's choosing discipline over comfort. It's choosing process over easy money. Now, most people will say yes to this one pretty quickly. But the real test comes with question number 2. And this is where we lose a lot of people. Do you have the courage to actually start, to take that first terrifying step? This is where self-doubt just comes in and assassinates people's dreams. People are so afraid they're going to fail, so scared of looking stupid or losing a little money that they never even get in the game. They just stay on the sidelines forever, reading and watching, but never doing.
And here it is, the last question, the ultimate one. After you find the courage to start, and after you inevitably get knocked down, take some losses, and get beat up by the market, do you have the guts to finish? Do you have that deep down commitment to see it through no matter how hard it gets? This is all about grit. It's about surviving the long, ugly grind. This is what makes a warrior.
So we end right where we started, but with a whole new way of looking at things. You are not just some person trying to guess which way a stock is going to go. You are in the business of professional decision-making. Every single day, the market is going to throw uncertainty and fear and chaos at you. But now, armed with a warrior's mindset and a tactical plan, the choice is yours. What will you decide?
What if I told you there was a trading secret that wasn't based on some hot tip from a guru, but on cold, hard data from millions of trades? Well, today, we are diving into the finale of short-term trading strategies that work. We're going to distill 16 proven data-backed strategies. This is all about trading with statistics, not with your bet. So let's jump right in.
Okay, so let's kick things off with a big question, one that really gets to the core of how most people think trading works. You see a stock that's just taking off, right? It's soaring. What's that first gut instinct? It's to jump on board. You want to buy that breakout, ride that momentum to the moon. But what if that very instinct is the thing that's actually killing your returns?
Well, the data in this book doesn't just kinda suggest a different path, it practically screams it from the rooftops. The statistics are just overwhelming. Chasing strength, buying those breakouts, it's a losing game in the short term. The most profitable move, it turns out, is the one that feels the most terrifying.
So to really wrap our heads around this, we're going to break it down into 4 parts. First, we're going to dig into the contrarian philosophy, the actual mindset you need.
Then we'll get our hands on the essential indicators, the actual tools of the trade. After that, we'll flip open the tactical playbook and look at specific setups. And finally, we'll talk about the two things that really separate the pros from the amateurs, your exits and your mindset. Okay, Section 1, a contrarian philosophy. Let's start with the big idea, the core principle that changes absolutely everything. This whole system, it's built on one simple, powerful act of rebellion. You buy weakness when everyone is freaking out, and you sell strength when they're all popping champagne. You do the opposite of the herd. And this right here, this is strategy number 1 in a nutshell. The numbers show again and again that the real edge comes from buying a stock after it's pulled back. I want you to think of it like a rubber band. When it gets stretched out, it has all this potential energy to snap back. That's what you're buying. Chasing a stock that's already shot up, that's like trying to grab the rubber band after it's already snapped. The edge is gone. Now, this isn't just some vague concept. It comes with some really simple, powerful rules. Strategy 2, you buy the market after it has dropped for a few days in a row. You're waiting for the panic to peak. And notice the second point, keep it simple. We're not overcomplicating things. And finally, strategy 3 is our big safety net. We're not buying junk here. You only apply this buy the dip strategy to strong stocks, specifically stocks that are already trading above their 200-day moving average. Section 2, the essential indicators. Okay, so if we're gonna buy weakness, how do we actually measure it? How do we do it with precision? This is where our quantified toolkit comes in. These aren't just feelings or guesses. These are the specific data-proven tools for timing your entries like a seasoned pro. First on our list is the VIX. You've probably heard of it. It's the fear gauge. When traders are scared, the VIX goes up. When they're greedy and complacent, it goes down. And for a contrarian trader like us, a high VIX isn't a red flag. It's a dinner bell. So how do we actually turn that fear into a weapon? Strategy 4 gives us a very precise rule. You're looking to buy when the VIX is 5% or more above its 10-period moving average. That's your signal for a short-term spike in fear, a perfect buying opportunity. And on the flip side, you're looking to take profits when the VIX is 5% or more below that average, because that means everyone's getting a little too comfortable. Now, that quote on the slide, that is a huge statement. But after backtesting countless indicators, the authors found one that just stood out head and shoulders above everything else for short-term trading. They literally called it the Holy Grail. Pretty cool, right? And here it is, the 2-period RSI, or Relative Strength Index. Now, hold on. Most traders you know probably use a 14-period RSI, which is fine for longer-term moves. But what this research found is that by cranking the setting down to just 2 days, you create this incredibly sensitive tool. It's like a seismograph for the market, picking up these extreme short-term tremors of panic and euphoria that everyone else just misses. And the rules for using it are so clean and simple. Strategy 9, you buy when that 2-period RSI drops below a reading of 5. That's a sign that a stock has just been hammered so hard, so fast, that a snapback rally is super likely. And strategy 10 takes it up a notch. It looks at the cumulative RSI. Basically, the longer the RSI stays that low, the stronger the buy signal gets. It's like a spring getting coiled tighter and tighter, just waiting to explode upwards. And this is where the real magic happens. When you start combining these signals, strategy 12 is all about this idea. When you got a green light from multiple indicators at the same time, the VIX is spiking, the 2-period RSI has tanked, you've built an incredibly powerful system for timing the market. It's all about waiting for those perfect moments when all the data lines up in your favor. Section 3, the tactical playbook. All right, we've got the philosophy, we've got the tools, now it's time to open the playbook. This is where we get into specific, recurring patterns based on time that give us yet another statistical edge to stack on our side. Okay, this slide is packed with some powerful timing strategies, and honestly, each one could be its own explainer, but let's do a quick flyby. Intraday, Strategy 7 says to use that same buy the dip logic during the trading day. Strategy 6 points to this weird thing called the overnight edge, where most of the market's gains have historically come when the market is closed. On a weekly scale, Strategy 11 gives us the double 7 setup for major indexes, and finally, Strategy 13 shows us there's a monthly rhythm, where buying at the end of the month, especially after a drop, gives you another little edge. All right, Section 4, Mastering Exits and Mindset. We've talked about what to buy and when to buy it, but that's only half the battle. We've now come to the final and, you could argue, the most critical section of all. This is about your exits and your own mind. These are the two things that will make or break you as a trader. I want you to just let that sink in. Most traders, especially new ones, are obsessed with the entry. They love the thrill of the hunt. But the professionals? They know that profit is locked in on the exit. We've all been there, right? You nail the entry, the trade goes your way, and then you give it all back because you didn't have a plan to get out. So, what does a smart exit even look like? Well, Strategy 14 says it can't be some fixed number. It has to be dynamic. The research found that a couple of simple exits work best, either selling when the price closes back above its 5-day moving average or using an RSI signal to sell into strength. And here's a spicy one from Strategy 5. The book actually argues that tight stop losses are often just expensive insurance. They get you shaken out on random noise right before the trade was about to work. So there you have it, the whole system. The contrarian philosophy, the indicators, the timing setups, and the exit rules. It's a complete data-backed trading plan. And yet, the book makes this really chilling point. Even with this entire system, most people will still fail. Why? Because they are missing the absolute most important piece of the puzzle. And there it is, Strategy 16. This is it. This is the master key. Your success or failure, it's not going to be decided by your charts. It's not going to be decided by your indicators. It will be decided in the space between your ears. So how do you actually forge that professional mindset? Strategy 15 gives us the blueprint. First, you have to have a plan to deal with the emotional chaos of trading every day. Second, you have to learn to use stress as fuel to make you more focused, not to make you panic. And third, you have to be relentless. Just focus on your targets and execute your plan day after day with total discipline. And that really is the big takeaway from all of this. It all boils down to a fundamental choice. Are you going to trade based on opinions or based on statistics? Every single strategy we just talked about has been tested, it's been quantified, it's been validated by the data. In a world that is just drowning in hot takes and predictions, this is your anchor. Opinions are fine, but when your own money is on the line, statistics are a whole lot better. So we'll leave you with this final question. You now have the blueprint for 16 short-term strategies that work. You have the philosophy, you have the tools, you have the tactics. But the only question that really matters now is the one you have to ask yourself. Is your mindset ready for the fight?